On August 15, 1971, President Richard Nixon severed the final link between the United States dollar and gold reserves. The Bretton Woods system, which had governed global monetary relations since 1944, collapsed in a single television address. What followed was not chaos, but something more structurally significant. The entire architecture of value storage began a permanent migration away from physical constraints and toward abstract confidence. Gold, which had spent millennia as the terminal settlement layer of human commerce, became optional. That optionality created a pattern that repeats across every subsequent metals cycle, a pattern driven not by industrial demand or geopolitical tension, but by the mathematical inevitability of monetary expansion colliding with finite supply. The mechanism is deceptively simple. When central banks expand money supply faster than economies expand productive capacity, purchasing power erodes. Investors recognize this erosion and seek alternatives that cannot be printed, mined faster than physical limits allow, or conjured through policy declarations. Gold and silver become pressure release valves in a system designed to tolerate inflation rather than prevent it. This is not speculation. It is structural response to incentive gradients that have remained unchanged since Rome debased its denarius, Weimar Germany printed papier marks, or Zimbabwe issued $100 trillion notes. The dates change, the denominations change, the underlying dynamic does not. Between 1971 and 1980, gold rose from $35 per ounce to over $800. Silver climbed from roughly $1 to $50 in the same period. These were not smooth ascents. They were volatile, punctuated by corrections that destroyed over-leveraged positions and convinced casual participants that the move had ended prematurely. Yet the fundamental driver, expanding fiat currency chasing limited physical assets, remained intact throughout. The Hunt brothers' attempt to corner the silver market in 1980 represented the euphoric terminus of that cycle, the moment when speculative excess overwhelmed structural demand and regulatory intervention became inevitable. Silver collapsed from $50 to below $11 within weeks. Gold corrected sharply but retained more of its gains because gold's holder base included central banks and sovereign wealth funds operating on timelines measured in decades, not quarters. This bifurcation between gold and silver introduces the first systemic complexity most investors misinterpret. Gold functions primarily as a monetary asset. Its industrial applications exist but represent a fraction of annual demand. Silver, by contrast, operates in two distinct markets simultaneously. Roughly half of annual silver demand comes from industrial applications including electronics, solar panels, medical devices, and water purification systems. The other half comes from investment demand and traditional uses in jewelry and silverware. When these two demand streams align, silver experiences exponential price acceleration because industrial users cannot easily substitute away from silver's unique conductive and reflective properties, while investment buyers chase momentum. When the streams diverge, particularly during economic contractions where industrial demand weakens while monetary fear remains elevated, silver exhibits schizophrenic price behavior that confounds pattern recognition. The period between 1980 and 2001 demonstrated what happens when monetary conditions stabilize and real interest rates rise. Gold declined from its 1980 peak to a low near $250 in 1999. Silver fell below $4. These were not aberrations. They were the predictable consequence of Federal Reserve Chairman Paul Volcker raising short-term interest rates above 15% to crush inflation embedded in the economy from the previous decade's monetary expansion. High real interest rates make non-yielding assets like gold and silver unattractive relative to bonds that offer substantial income. The entire metals complex entered a two-decade bear market not because the assets became fundamentally worthless, but because the opportunity cost of holding them exceeded the perceived benefit in a disinflationary environment. What changed in the early 2000s was not investor sentiment but monetary architecture once again. Following the dot-com collapse and the September 11th attacks, the Federal Reserve began a sustained campaign of interest rate suppression and liquidity provision. The federal funds rate dropped from over 6% in 2000 to 1% by 2003. Simultaneously, global central banks, particularly in Asia, accelerated dollar reserve accumulation to maintain export competitiveness. This created a structural bid for dollars that allowed the United States to run persistent trade deficits without immediate currency consequences, but it also meant that dollar creation accelerated beyond any historical precedent outside of wartime. Gold responded first, beginning a steady climb from its 2001 low. Silver followed with greater volatility but ultimately larger percentage gains. By 2008, gold had surpassed $1,000. Silver had climbed back above $20. The 2008 financial crisis represented an inflection point that revealed how deeply the global system had become dependent on credit expansion rather than capital accumulation. When Lehman Brothers collapsed in September 2008, the entire commercial paper market froze. Money market funds broke the buck. Counterparty risk became systemic. Central banks responded with interventions unprecedented in scale and scope. The Federal Reserve's balance sheet, which had remained relatively stable near $800 billion for years, exploded past $2 trillion within months. Quantitative easing, initially described as a temporary emergency measure, became permanent policy infrastructure. Gold's response was immediate, climbing from under $700 in late 2008 to over $1,900 by September 2011. Silver surged past $48 before collapsing in a violent correction that mirrored its 1980 behavior. What separates informed participants from speculative casualties in these cycles is understanding the difference between price momentum and structural persistence. Price momentum attracts attention and generates excitement, but it reverses suddenly when leverage unwinds or regulatory pressure materializes. Structural persistence, the underlying demand for monetary alternatives in an environment of sustained currency debasement, continues regardless of short-term volatility. Investors who mistake momentum for structure typically enter positions near peaks, experience sharp drawdowns, and exit near troughs, converting paper losses into permanent capital destruction. The pattern repeats across generations because human psychology responds to recent price action more powerfully than to long-term incentive structures. The decade following the 2011 gold peak demonstrated another systemic pattern that appears in every commodity cycle. From 2011 to 2015, gold declined from $1,900 to below $1,100. Silver fell from its 2011 high near $50 to under $14 by 2015. Mining equities, which had soared during the bull phase, declined even more severely, with many junior exploration companies losing 90% or more of their market capitalization. This was not irrational panic. It was the predictable consequence of a supply response to high prices that had been delayed by the long lead times inherent in mine development. Between 2002 and 2012, global gold production increased from roughly 2,500 tons annually to over 2,800 tons. Silver production rose from approximately 19,000 tons to over 26,000 tons. When this new supply arrived in markets where investment demand had weakened due to rising nominal interest rates and stabilizing inflation expectations, prices corrected sharply. What makes this supply response particularly relevant now is that the opposite dynamic has been building for nearly a decade. From 2013 onward, capital investment in new mining projects collapsed. Major mining companies, having destroyed shareholder value through acquisitions at peak prices and cost overruns on development projects, shifted entirely toward capital discipline and shareholder returns. Exploration budgets were slashed, marginal projects were shelved, the average reserve life at existing operations declined as depletion exceeded replacement. By 2020, the pipeline of projects capable of reaching production in the next 5 to 7 years had contracted to levels not seen since the late 1990s. This matters because mines do not appear on demand. They require permitting timelines measured in years, if not decades, capital expenditures measured in billions, and technical expertise that cannot be easily scaled. When prices rise and demand accelerates, the supply response arrives years too late. Current price action in metals markets reflects this delayed supply response colliding with renewed monetary expansion. Following the March 2020 economic shutdown, global central banks deployed stimulus measures that dwarfed 2008 interventions. The Federal Reserve's balance sheet expanded from approximately $4 trillion to nearly $9 trillion within 18 months. Fiscal deficits in the United States exceeded $3 trillion in 2020 and approached $3 trillion again in 2021. These were not temporary emergency measures that would be promptly reversed. They represented a structural shift in how governments finance expenditures, relying on central bank balance sheet expansion rather than taxation or genuine bond market discipline. Gold's response has been methodical rather than parabolic, rising from its 2018 low near $1,200 to over $2,600 by late 2024, with recent reports indicating approaches toward $3,100. Silver has exhibited its characteristic volatility, oscillating between $18 and over $30 multiple times before recent surges past $100. The critical question facing current participants is not whether metals can rise further, but whether the conditions that terminate bull markets have materialized. Historical precedent offers clear indicators. Bull markets in metals end when real interest rates rise substantially above zero, when monetary policy tightens sufficiently to create genuine disinflationary pressure, or when regulatory intervention deliberately suppresses markets perceived as destabilizing to the broader financial system. None of these conditions currently exist. Real interest rates, calculated as nominal rates minus inflation, remain negative or barely positive in most developed economies despite recent rate increases. Central banks have raised nominal rates but continue expanding balance sheets through various liquidity facilities and asset purchase programs. No regulatory framework has emerged to restrict metals ownership or trading beyond existing anti-manipulation statutes. The behavioral indicators that typically accompany market peaks also remain absent. True speculative manias exhibit specific characteristics that are quantifiable rather than subjective. Margin debt in brokerage accounts rises to historical extremes as investors leverage existing positions to buy more. Retail participation surges, visible through increased trading volumes in options, futures, and exchange-traded products. Media coverage shifts from skepticism to celebration, with mainstream financial outlets publishing bullish projections and analyst upgrades. Most importantly, price corrections become buying opportunities that are immediately absorbed rather than panics that accelerate selling. By these measures, current metals markets remain in expansion rather than exhaustion phase. Margin debt has risen but remains well below peaks seen in equity markets. Retail participation has increased but has not reached the frenzy levels that characterized silver's 2021 meme stock-style surge or the cryptocurrency mania of late 2021. What distinguishes professional capital allocation from amateur speculation in these environments is systematic risk management rather than price prediction. The most common error inexperienced investors make is conflating volatility with risk. Volatility measures price fluctuation over time. Risk measures the probability of permanent capital loss. A highly volatile asset can have low risk if the underlying fundamentals support eventual price recovery, while a stable asset can have high risk if it is slowly eroding purchasing power or faces structural obsolescence. Gold and silver exhibit volatility because they trade in liquid markets where participants have different time horizons, different leverage ratios, and different motivations. This volatility creates opportunity for disciplined buyers during drawdowns and necessitates position sizing that tolerates fluctuation without forcing premature liquidation. The mining equity sector introduces additional layers of complexity that separate it from physical metals ownership. A mine is not simply leveraged exposure to metal prices, it is an operating business with production costs, capital requirements, labor relations, environmental liabilities, political risks, and management quality issues that can destroy value even when metal prices rise. The junior exploration sector, which encompasses companies without producing assets, operates on an entirely different risk-return profile. These companies are effectively call options on geological success, requiring not only metal price appreciation but also successful drilling results, permitting approvals, financing availability, and ultimately acquisition by a larger producer or development into a mine. Historical data shows that fewer than 1 in 1,000 exploration projects becomes a producing mine. This does not make the sector uninvestable, but it requires position sizing that acknowledges the binary outcomes inherent in exploration risk. The current configuration of metals markets presents a scenario that has appeared only occasionally in the past century. Monetary expansion continues at rates incompatible with stable purchasing power. Supply constraints in physical metals have become structural rather than cyclical. Industrial demand for silver continues growing due to energy transition applications that cannot easily substitute to alternative materials. Yet mainstream institutional participation remains limited, with most pension funds, endowments, and sovereign wealth funds maintaining minimal or zero allocation to physical metals or mining equities. This creates the possibility of sustained price appreciation driven by incremental capital inflows rather than speculative excess, a pattern more similar to the 2002 to 2008 period than the parabolic 1979 to 1980 blow-off. The terminal risk is not that prices cannot rise further, but that participants will mismanage positions during inevitable volatility. The metals complex does not move in straight lines. Corrections of 20 to 30% occur even within bull markets, not as signs of structural failure but as normal resets of technical conditions and sentiment extremes. Investors who size positions appropriately, maintain liquidity for opportunistic additions during weakness, and resist the psychological impulse to sell into panic can navigate these cycles successfully. Those who concentrate capital at price peaks, employ excessive leverage, or abandon positions during normal corrections will convert what could have been profitable long-term holdings into realized losses and missed opportunities. The market does not care about intentions or beliefs. It responds to positioning and behavior, rewarding discipline and punishing emotional decision-making with mechanical consistency. The question is not whether the system will eventually address the structural imbalances that drive metals higher. The question is whether that resolution arrives through deliberate policy reform or through market-imposed discipline that governments and central banks can no longer control. History suggests the latter occurs far more frequently than the former, not because policymakers lack intelligence, but because the political incentives that govern their decisions prioritize short-term stability over long-term sustainability. Until those incentives change, the mechanisms that drive metal cycles will continue operating regardless of whether individual participants recognize them.